The markets kicked off 2025 with volatility, reminding investors that pullbacks are normal and even healthy after the remarkable gains that we had in 2023 and 2024. While we anticipate a more measured pace of growth this year, resilient economic fundamentals keep us optimistic. In this video, we discuss what lies ahead, from shifting Federal Reserve policy to earnings, to a new administration, and how these factors may shape the year for investors.
Economic data has been better than expected to start the year. Non-farm payrolls had a blowout report last week, adding 256,000 new jobs in December, and the unemployment rate ticked down to 4.1% from 4.2%. And average hourly earnings growth remains strong. Put that all together and it reads like a Goldilocks soft landing print. Solid and stabilizing payrolls growth paired with continued cooling wage growth. So, why did the equity market and the bond market sell off earlier this month? Because the better than expected economic data may change what the Federal Reserve does with interest rates. Remember, the Fed lowered interest rates last year due to concern over a softening labor market. So much so, they lowered rates by 1%, or 100 basis points, from September to December. Heading into 2025, the market expected 2 rate cuts this year. Now the market expects only 1 rate cut in the fall, given the strength of the labor market and inflation cooling less than expected. Unsurprisingly, bond yields surged and equities dropped on the change in interest rate outlook. This is because rate cuts lower borrowing costs, encourage spending and investment, and all else being equal, should boost stock prices. Fast forward to this week, the Consumer Price Index, or CPI report, showed that it rose 0.4% in December, matching consensus expectations. CPI is up 2.9% from a year ago, still above the Fed's 2% target, but continuing its downward trend, the most important point. We believe that strong economic growth and cooling inflation is more important than the pace of interest rate cuts. And historical data supports this conclusion. Historically, the S&P 500 tends to experience less downside when the Fed engages in a slow rate-cutting cycle. Slow rate-cutting cycles are typically associated with stronger economies and bull markets. Fast rate-cutting cycles are typically associated with recessions and bear markets. We view pullbacks as healthy and normal. The S&P 500 ended 2024 up 25% with very little turbulence along the way. Corrections or pullbacks of 10% happen once per year on average, but the biggest drop in 2024 was only an 8.5% slide, well below the norm.
We expect 2025 to be another positive year for equities, but we don't foresee the outsized returns that we had in 2024 and in 2023. Now, the year-end price targets range from 6,000 to 7,100 for the S&P 500, depending upon the analysts, and the bottom-up price target is right around 6,750, which is 12.5% from current levels. We think this is a reasonable target because we believe 1, earnings growth, and 2, strong profit margins can take us there. Fourth quarter year-over-year earnings growth is expected to come in right around 11.7%, and analysts expect full 2025 earnings growth to come in at 14.8%, both of which are above historical levels. So this is good. And we're already starting to see positive results in the Q4 earnings reports. Big banks, which are reporting right now, have been very positive, and we'll be keeping a close eye on the much anticipated mega cap tech and Magnificent Seven earnings to see if they can continue to deliver better than expected results. And we think they can. AI and technology-driven companies continue to outperform. And as we've said before, we believe we're in the early stages of a technology and AI boom.
We expect clarity on executive orders immediately after President Donald Trump's inauguration next week. But don't anticipate broad-reaching and substantive policy on immigration, tariffs, and deregulation to take effect immediately. Tight margins in the House and the Senate remind us that there are guardrails and checks and balances to sweeping reform. Tariffs and immigration reform, which can be implemented by way of executive order, pose uncertainty for the economy and for the Fed's continued fight against inflation. The potential for less regulation is being applauded by corporate America and the stock market. Only time will tell how all of these policies impact the economy and the market. As we've said before, the economy and corporate earnings are more important to the performance of the market and your portfolio than who sits in the White House. We continue to be deliberate in how we structure portfolios for the environment ahead. We believe owning high-quality, cash-generating companies with low debt loads will bolster performance and reduce volatility, especially around the uncertainty about the pace of interest rate cuts. We look forward to the year ahead and thank you for the trust that you have placed in our team. As always, please do not hesitate to reach out if you have any questions or we can be of help.